Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock and I'm the CEO of Hardman & Co. And I'm joined today by Jason Streets, one of our very experienced analysts. Jason's been top ranked in several sectors in his career, but is here today to talk about his latest note on asset managers, which is entitled Radical Derating, presumes things only get worse. It's great to have you here today, Jason.
Oh, great to be here. Thanks, Keith.
So before we get started on asset managers, Jason, could we just have a little bit of background from you about you and about the asset management sector?
Yeah, sure. So I started in the city in about 1985. On the buy side, I was actually in fund management for the first 8 years of my career. I then moved to the sell side and I covered the leisure sector for about 7 or 8 years, and then briefly moved into the internet and media and a very quick sojourn doing specialised customised research. But in 2003, I was asked to take over the general financials coverage at UBS, of which the biggest subsector is asset managers. And when I was there, we floated 4 different asset managers: Charlemagne, New Star, Henderson, and Ashmore. And in subsequent jobs, I was brokers to City of London Group and then Foreign and Colonial. And I think it's quite interesting that of all those, the only 2 that are still listed are Ashmore and City of London, which are both emerging market managers.
Thank you for that. Is it a difficult sector to cover as an analyst?
No, I don't think so. I think it's quite easy, really. They're very transparent businesses, and obviously it helps that you have a sort of innate understanding of the dynamics of the business and how it works. I mean, there are a couple of tricky things when you're writing about clients of the business, but otherwise it's an easy sector to understand. It's not an easy sector to call right because it's very volatile and very high beta. I mean, the way I think of it is that the market drives the sector in 3 different and compounding ways. So the first is that obviously revenues are generally dependent on market levels. Fees are charged as a percentage of assets under management. So as markets go up, fees go up. And then secondly, as markets go up, money gets sucked in. People tend to put more money in as markets go up. So you get an extra ramp from that. And then thirdly, as markets go up, there tends to be a bit of multiple expansion, and these companies are listed markets and they get a bit of multiple expansion too. So you get that sort of treble link to the market, and you combine that with some quite significant operational gearing. I mean, there are a lot of fixed costs. Obviously, there's some variable compensation as well, but this is a very high beta, high geared sector.
So the title of your recent note refers to a radical derating. And I think in it you've compared asset managers to investment platforms and wealth managers. Can you give us a feel for the scale of the derating?
Yeah, well, so this article I wrote was a reprise of one I wrote back in February 23. And I looked at the performance from when I wrote that article to now. 2 of the asset managers have disappeared. But the 13 listed ones that were there, have been in both periods, have fallen between February 23 and April 25 by an average of 45%. And this is when markets in that time have been up. I mean, just looking at the States at the same time, the asset management sector there was up 11%, but then the S&P itself was up 40%. So even there, there's been a relative derating. I mean, just focusing though on the UK, if you look at market cap to EBITDA, roughly the same as EBITDA, but we tend to include the cash in the business because all of them carry additional cash, some more than others. If we look at that multiple, in that time, it's fallen from 9.9 times to 6.8 times. And the interesting thing here is that in that time, earnings have not gone down, assets under management have not gone down, they might not have gone up as much as people expected, but it's hardly been calamitous. We've just seen this huge derating, and the derating applies to both the platforms and the wealth managers too, though not quite as much. I think the platforms have fallen from 17.5 times to 14.2 times. Wealth managers have actually seen a contraction similar to the asset managers, in fact. So it's been very substantial, and I think slightly surprising, really.
Well, why do you think it's happened, Jason?
The best explanation I can come up with is that people are concerned about the flow of money, existing money and new money, into index products, and more recently into privately owned assets, not listed assets. Now, all the companies in the UK, none of them have any index exposure, and they're all pretty weak in private assets. But as I say, despite the fact that we've seen those flows in those directions, we haven't actually seen a fall in AUM. So it seems to me that the derating must reflect an assumption that those flows will continue pretty much indefinitely, and therefore we will see ultimately earnings decline and the business sort of shrivel. Otherwise, I just can't see why we should see the contraction that we have. And my feeling is that we could well be at or near the top of this trend to indexation. It may well be that the activity we've seen with Trump in the last few weeks, the negative impact that will have on US markets and confidence in the US might well prove to be the peak of money flowing that way. On the private asset side, not so clear. I mean, the regulators seem to be keen to encourage asset managers, wealth managers to give more access to private individuals, to private assets not listed on markets. Right at the moment, I think we've probably seen the peak of their returns. I mean, there's plenty of evidence to suggest that the biggest component of outperformance by private equity has simply been a function of very low, long period decline in interest rates. And that's obviously come to an end. And actually, what we're seeing currently is large funds struggling to sell their underlying investments. So it doesn't seem to me to be a very good time to be encouraging the retail investor to step in and take up the cudgel from professional investors who've had all the meat off the bone.
Thank you, Jason. Any last comment you want to leave with us? I mean, I think you might believe that one of the asset managers is really quite symptomatic of the problem.
Yes. So, I mean, interestingly, last time round, one of the wealth managers called Quilter was actually trading at negative enterprise value. That is the pile of net cash and investments on its balance sheet was actually larger than its market capitalization. And that was one of the few stocks that did well. That was up nearly 50% in this period. There's a similar situation with Jupiter Asset Management. When I was writing, the net cash was almost identical to the market cap. It's up a few percent since then, but it's very, very close to being able to buy the business for nothing. Now, Keith, you and I know we're not in the business of making investment recommendations, and I'm not making a recommendation here at all. But what I'm saying is, I think this is well worth people's time to go and do their own due diligence and look at that, bearing in mind that you're paying today virtually nothing for the underlying business.
Jason, thanks for your time.
Thank you, Keith. Always good to see you.
Now, you can view Jason's paper on asset managers for free on our website, hardmanco.com. As always, thank you for watching. Please don't forget to like this video and join in the conversation wherever you are watching, and we'll see you next time.